I mean, maybe we flush quickly to 20, but generally bear markets don't end this quickly. So I think it's got to be a little bit more drawn out. Like, so the inflation numbers are ridiculously high right now, but the Fed has to be very careful here because you are seeing consumers starting to recoil like they just touched a burning hot stove. All right. Again, so far we're still seeing, we're always hearing, oh, the traveling because COVID's, kind of down and over at this point. But I'm telling you right now, from what I'm seeing, people aren't driving as much as they were because, it takes $120, $130, $140 to fill up your tank just for a few days of driving, right? And then you also have prices that are ripping higher. We know that housing has been just going nuts, so people can't afford that with interest rates where they are. And there's this massive recoil that's starting to take place, and it can force us into a recession far, far faster than anyone thinks. I went on record, I think 6 months ago, saying we could easily see a recession start by the end of 2022 into early 2023. And I think that's going to happen. Particularly, number one, it takes some trickle through effect, right? So especially when prices go up on the producer side, they're not going to raise it all in 1 month and pass it on to the consumer, because then you would see the consumer stopping to buy their goods. So what they do is they try to do it more incrementally, which keeps inflation higher for a longer period of time. We then talked about wages. I've talked about this with you before, but as good as it is for people to earn more money and get paid more, at the same time, it does cause an increase in inflation as well. And so you have all these kind of trickle through effects. And I do think inflation will come down as people recoil. We saw, I think it was Target News last week that said, they had a huge inventory, so they were going to start marking down things. So I do think inflation eventually does come down, but people are going to react to their 401ks getting cut down by 20 or 30%. Smaller investors seeing crypto markets collapse and their portfolios down 50, 60, 70%, they're going to react to that. That's wealth effect that was created during COVID is vanishing very, very quick. No, 100% right. And that's kind of what I'm thinking too, is I don't think it's as easy. Maybe we flush quickly to 20, but generally bear markets don't end this quickly. So I think it's got to be a little bit more drawn out. I think if you look at past bear markets in general, it's taken about 12 months from the peak on Bitcoin, for instance, to get down to its low before then it goes choppy sideways for about 6 months before it starts to kind of increase. And we're, if we look at November being the high, we're still quite a ways away from November now, when a potential low could be put in. So it'll be interesting to see. And again, the more interesting thing for me is going to be, what does the Fed do when we do enter a recession if inflation is still at 6% or 5%? How do they react when they can't print ad nauseum the amount of money that they were in the past? Yeah, totally. No, it's amazing. This is definitely a market that investors need to understand. So many investors came in after kind of the 2020 flush with COVID, and they've never experienced a longer term bear market. And it's kind of a wake up call. I know you and I have been through many bear markets out there and collapses, but there's a lot of the population that hasn't been. And it's welcome to the club, essentially. Unfortunately, it's a club that we don't necessarily want to be in, but it is a club that everyone becomes. Yeah. So we have the S&P here. So pre-market, when we're doing this interview here, we're trading right at this little pivot low right here, which is around 380, 381. So that's going to be a big level to watch today going into the rest of the day. I still think these equity markets, and I think I've even said this since late 2021, is that you have to, if the Fed is really withdrawing liquidity and stopping the QE, then you're likely going back to that pre-COVID high. So that's still at 340, which is still, from the pre-market levels here of 380, we're still talking another 40 points on the spiders to the downside. That's 400 on the S&P 500. And that's, once we get there, I think you get a sustainable bounce. I don't think it's the bottom for the markets because, again, I still don't think inflation will be under control, so the Fed can't print money again. But I do think you'll get a kind of okay, we've washed out all that fluff and all that money from the COVID massive stimulus. Now let's kind of reevaluate with where the economy is. And then probably the next leg comes in 2023 when we are officially in a recession and people start worrying about how bad of a recession. Is it going to be a depression? You'll start hearing that. Is it going to be stagflation? All of these things could be the next leg down, but I think just what we're in right now takes us to 340 on the spiders. So at 293 down to 230, so 290, so 60 60, it was about 20, just over 20%.
Okay. And where are we at now in our current drop?
S&P 500, 480 to 380. So that would be just under 20%, right?
Yeah.
Or actually, yeah, right around 20%. Say is that in 2018, the Fed backed off and went back to money printing within months. They can't do that now. So to me, this is a scenario where it's very likely you'll see double that drop, because they can't come out and rescue it. Yeah. I mean, that would be incredible to get back to that. I mean, I have to even go to my weekly chart here to get back to that.
Yeah, you got to get on the weekly and, think about, where that was before, all of this big melt up started.
I'm a big believer that markets revisit levels. So for instance, if you look at the weekly and you go back to the high, so we have this beautiful double top going back to 2000 and then to 2008, right? So yep. Right there. And again, this is kind of that horrible scenario that none of us hopes happens. But if we get into that really horrendous, Great Recession, Depression-ish type scenario, it would not shock me to see the markets retest this high. We never really retested it. Once we broke out, we were off to the races. We never, ever retested it. That's somewhat unusual for markets. Usually markets, what they do is they break above it, and then what they'll do is they'll check back to it, right? So if you draw the trend line through here, they check back to it, and then they go on their merry way. We never did that. I agree 100%. And again, people would say, well, that would be way too low in terms of price to earnings on the S&P. But you have to remember that if we go into a bad recession, those earnings estimates are going to come way down. And by the way, they haven't even been dropped yet by analysts. That's still coming. That's still another shoe to drop here just for what we're going through right now, let alone if we get into a bad recession where they're going to get taken down even more. So it's
well, PE is relative to interest rates, right? So right. Your PEs adjust with interest rates. So if your rates are back to where they were, back then, your PEs will adjust back then. The only reason we have them where they're at now, 14, 15 times, is because zero interest rate policy.
Right. 100%. You're right. And that's been my big gripe with Apple is that, you look at Apple, it was a $3 trillion company. And how do you justify when it was at its highs, a 30 PE ratio? I mean, historically, a company like Apple would be at like 12 or 10, which is really scary because think about the amount of downside on that. And you're talking about cutting the price target by 66%. Yeah, and I have to run in a minute to get ready for the market open, but I want to say this to everyone. Obviously, Greg and I are talking very bearishly. Understand that in bear markets, the opportunities are incredible, but you have to be very careful. And I've had my swing trading year has been going long most of the time, but I'm buying specific dips and then selling the quick rips. And so my point is that bear markets are not the end of the world. Yes, you have to be nimble. It's not easy like closing your eyes and throwing a dart at a board and just making millions of dollars, but bear markets breed the best opportunities for investors in a big period. So just keep that in mind, is that as bearish as it may seem out there will be opportunities, but you actually have to use intelligence, right? It's not the close your eye market where you can just pick anything. So just keep that in mind.